Hello, this is David Kroll for Money Matters, and I'm from Mortgage Network, as you remember, and I'm returning for the second half of the show. So I was talking about the run in the stock market, which has continued and been amplified since the election, and the corresponding collapse of the bond market or downturn in the bond market that has occurred over the same period of time. The antithetical, the opposite, the converse, reverse relationship between stocks and bonds has been long established. That's nothing new. Where one goes, the other goes the opposite direction most of the time. Sometimes they go together, which is another whole subject. But most of the time, when one goes one way, the other goes the other way. Typically, the stock market rises on positive economic news, and typically the bond market rises, in other words, bond prices go up, on bad news. Why do bond prices go up on bad news? Because when there's bad news, people yank their money out of the stock market and want to put it someplace safe. Bond markets represent safety. So, the point that I got to in the first half was bond market pricing is going down, so people are willing to pay less and less for bonds. It means the yield is going up. The yield has increased 50% on 10-year treasuries in the last 4 weeks. 10-year treasuries are the major indicator for mortgages, which would indicate that mortgages over the next period of time are very likely to go up by as much as 50%. What does that mean? Well, 4 weeks ago, the 30-year fixed rate mortgage was at 3.5%. A 50% rise in that number would push us to 5.25%. We're not there, we're at 4.25%. But in a very short period of time, in a 1-month period of time, we've gone from 3.5% to 4.25%, and the structure is there. The bond market structure is there for that rate to continue to increase in Fannie Mae 30-year mortgages up to the high 4s and into the low 5s. The first question that you need to entertain at that point, so what I'm giving you is not opinion, I'm giving you sort of structural facts about the market. Are mortgage rates going to go to 5 or 5.25%? It would appear so at some point in the coming months, or certainly within the next 6 to 9 months. Where are they today? 4.25%. Where is that in relationship to where they were? It's a good 25-30% higher than 4 weeks ago. Now, what does this mean? At some point in the increase in rates, you're going to see a impact on borrowers' ability to buy homes. The 3.5% rates increasing to 4.25% does not greatly impact anybody's ability to purchase real estate. On a $200,000 mortgage, an increase from 3.5% to 4.25% will increase the cost of that mortgage approximately $120 a month. So somebody buying a $200,000 home is going to find that mortgage, let's say they're going to find that home approximately $100 a month or $120 a month more expensive. Somebody buying a $400,000 home, they're going to find the monthly cost somewhere in the region of $200 to $230 a month greater. That's the impact on the mortgage market. If it continues up from 4.25% to 5%, then the cheese gets, as they say, a little more binding. For the purchase of a $200,000 home, the price increase, the monthly cost is about $200, and for a $400,000 home, about $400. So it becomes more noticeable, and it reaches a tipping point where in certain markets and for certain people. People are forced out of that price bracket of the market. So that's one of the massive impacts that going forward you'll hear lots of conversation about. The other big impact of a collapse in the bond market is that interest rates go up not just for consumers, but they also go up for corporations, and they also go up for governments. So let's look at corporations first. If interest rates go up for consumers and go up for corporations, who benefits? The banks. Well, guess what? In the last few days, bank stocks have absolutely soared. Bank of America has gone up something like 30% since the election. Other major banks, 20, 30, 40% since the election. The banks will make more money, lots and lots more money, because at the artificially low interest rates that we've had for the last 2 or 3 years, the banks can simply not charge excess profit. They can't adjust their pricing to market demand very easily. The cost of funds and the price to the market to the consumer of funds and to corporations has been super low. Now the spread is opening up, and banks are the immediate beneficiary, and the stocks in the equities market of banks has gone soaring. So that's who wins. Who loses? Well, arguably the consumer loses and corporations lose because the cost of borrowing is greater. The argument there is that they don't really lose because in a growing economy, everybody wins because they earn more money on the consumer side and they make greater profits on the corporate side. We'll see. Who else is in the bond market? Big time. Governments. Governments are the biggest participants in the bond market. The U.S. government, the United States government, borrows trillions of dollars, has a, I don't know, $24 trillion debt at the moment. If that debt increases in cost 50%, which is just done, and then increases a further 50% and goes to a cost of 3.5% or 4%. Now remember, it was at 1.5%. The bulk of U.S. debt melded on a melded rate basis is at about 2.3%. We're just hitting that 2.3, 2.4% rate for 10 years right now. If it increases another 50% or even 100% over that, if it goes to 3.5% or 4%, there's a serious question as to how the United States can pay its debt obligation. Remember, it's exactly, I just gave you the example for a home cost going up $100. Well, the U.S. government is going to have to double its interest payments, and the cost of its debt is already something like 40% of the entire federal government budget. So you can see what happens. If we have a tax cut, as proposed by the administration, at the same time as we have an increase in the cost of debt, at the same time as we have stimulative policies to build infrastructure and to get the economy moving, the combination of those three could easily lead to the one thing that nobody is yet talking about, which is a instantaneous negative cycle, basically a collapse and a recessionary cycle. Because what happens is that the inflation rate bumps out of control. Based upon that, the interest rates bump out of control. The cost of money to the largest borrowers is suddenly out of control, and everyone runs for cover. The United States government is the most stable of all, and it would have trouble paying its debt load. Russia would immediately default. I mean, we're talking, Emily and I talked 9 months ago, 10 months ago about this very problem. The pieces of it are coming into focus. So next week we'll see where things are and we'll see whether this cycle has slowed down. Until then, have a great week and enjoy your stock market gains for this week anyway. And this is David Kroll signing off for Money Matters.